Hello everyone, I'm Kyle Cheropita and this is The Upside. Today we'll be looking back at the month of May with some FidelityConnects clips to frame the market action this month. In May, global financial markets were shaped by a mix of strong corporate earnings, particularly AI-driven optimism, against renewed geopolitical instability, continued trade disputes, and uncertainty around inflation, interest rates, and policy expectations. Despite this, equity markets in Canada, the US, Europe, and Asia remained resilient. Also, rising crude oil prices have raised fresh questions about inflation and central banks, leaving investors wondering where to look next. David Wolf, portfolio manager on Fidelity's global asset allocation team, says that when it comes to Canada, investors still have time to get in early, with much of the long-term upside not yet priced in. Here is David with host Pamela Ritchie.
One of the pieces of that seems to get discussed a lot is the energy dependency story and energy independence, which arguably leads you to a discussion of Canada. There's also other roads to Canada in this discussion as well, but that's one of them. What we have to offer to the world, and whether we can offer that to the world more, essentially, which seems to be what we're sitting at. I don't know if it's a precipice we're sitting at, but we're sitting at something that seems to be the beginning of that taking hold in our economy and therefore your investments. Take us through how you get to this.
Sure. So again, a couple of things to unpack there. The first I would say is we don't know how the Iran war is going to work out, and we don't know what oil prices are going to do, over the next week, month, year, what have you. Nobody does. But no one in the world is going to look at what's happened and say, gee, I'm less worried about energy security and reliability of supply. So this is a world where those who have that reliable energy supply are going to increasingly be rewarded. And Canada is one of the relatively few countries that has a lot of energy and can be counted on in terms of producing and selling that energy to others. Now, we don't really have the capacity to do that at this stage, or at least to ramp it up. And that's why I think it's really important. A lot of what we're seeing, not only in the market, but from the government, that basically has been quite clear, at least in my eyes, to say, we get that unsticking energy investment in Canada is maybe the most important thing we can do for the broad economy over the long term. So we're going to try to do the things that foster that. We're going to try to give support to private investment. We're going to put in public investment. We're going to try to give predictability in terms of climate costs around that. It's not going to work tomorrow. It's not going to work next year. But it's the kind of thing that can pay real dividends down the line. And it's an environment where it's really sort of mistrusted or doubted by the market, because for many years, nothing happened. So there's a real skepticism in terms of, can you actually do this? And maybe we can and maybe we can't. But the upside is there and it's not priced, which is one of the reasons why, as you know very well, we were underweight Canada for 13 years and we're not underweight Canada anymore.
I mean, when I met you originally, I think you had a really low target on the Canadian dollar, and that low target stayed for lots of different reasons. The Canadian economy was dependent on housing, essentially, for growth for many, many years. That is over now completely, or where would you take us in there? That's over.
Yeah, I mean, the housing market, so our view has been, and you and I have talked about this.
And we haven't gone into recession over it.
Yeah, so you and I have talked about this on this program for years and years, which is the Canadian economy was basically on a sort of road to nowhere, where all that was driving growth was basically borrowing a bunch of money, building houses and selling them to each other, which is ultimately kind of how you eat your own economy, because that doesn't do anything for your productive capacity in the long term, and it just adds to debt that you're then going to have to pay off. So now we're seeing the other side of that, with the housing market very weak in a lot of parts of the country. And so what you need to do is have something in the economy replace that growth. And right now it's not that much, which is why the overall economy is quite stagnant. And again, it's why the imperative exists, particularly at the government level, to actually drive higher capital investment to be able to sustain the economy short term, but also provide for that higher productive capacity long term that's going to allow us not to get on the road to nowhere again.
In recent months, investor sentiment around artificial intelligence has swung between exuberance and caution. Markets have been lifted by strong earnings from major tech players and growing confidence that AI spending could translate into real profits. But at the same time, investors question valuations and expect clarity on billions in circular AI investment. Hyun-Ho Son manages Fidelity Technology Innovators Fund and is a contrarian tech investor who searches for opportunities in high-quality, durable growth companies. And he reminds us there are other drivers in the tech sector. It's not just about AI. He dialed in from London, joining Pamela Ritchie on Connects to kick off May.
When software was selling off so hard through from November through to the winter months, were you able to step in, not to catch a falling knife, but were you able to step in faster than some because you could see which companies, in fact, were not going to be, longer term losers essentially in this area?
Yeah, I mean, since last November, software stocks, particularly software as a service (SaaS) stock, came up indiscriminately, and those blanket sell-off, I was able to increase my exposure to software names, particularly large cap software, and more things like mission critical ERP software companies just went down a lot, and now valuation and risk reward have become quite attractive. So yeah, I before November I was underweight in software space, and now I'm overweight in software sector overall.
And ironically, maybe, I don't know if that's the right term, but there would be some protection from the circular financing risk within other parts of the industry. Is that fair? I mean, software is not receiving that, for instance, when you look at risks in other parts of the market.
I wouldn't look at protection from circular investing, but because of the fear about the AI disruption, I think the investor have forgotten about the high quality nature of software business, mission critical, high switching cost, recurring business, and those companies will have time to respond and respond to competitive threat and embrace AI technology. So I think that the big software companies will be users of AI and then continue to evolve their business. And if you think about like software company that have gone through multiple technology transition, like IBM and Oracle, these companies have gone through mainframe, server client, and cloud computing. I mean, all these technology transition, and some companies that phenomenally embracing new technology and transform themselves. And we're gonna see more software company from that perspective.
On Wednesday, May 20th, Fidelity Canada launched several new funds and ETFs. Rory Poole, Director Alternatives, sat down with portfolio managers Peter Kahn and Olivier Simon Vermont about their new Fidelity Alternative Bond Fund. With markets shifting and ever-present inflation concerns, the fund's flexible approach lets them adapt quickly, using deep research and global teamwork to spot opportunities and dodge potential risks. They see this fund as a smart addition to any portfolio, as they blend short-term investment-grade bonds for stability with high-yield allocations for enhanced income. Take a look.
How would you describe, how the two of you invest to an average investor?
Yeah. Well, I'd start by saying, I'm trying to be as flexible and objective as possible, right? I'm a trader by background, and the trader's mantra is always that there's a price for everything, and the riposte to that as well is the price today, right? So we're trying to work very hard to ascertain whether or not the implied valuation in the market today is in accordance with the intrinsic valuation, from the great work from the research teams globally, and putting that together in a fashion that is as objective as possible. Sounds easy to do, but you find that as time goes on, it becomes difficult when you work with a lot of intelligent and persuasive colleagues, right? So one of the most challenging things for me to do, if you will, is maybe even be like the bad cop to Olivier's good cop sometimes and say, we're not getting this right, or we're missing an opportunity, it's time to move on, or we need to cut and move on. It can often be, that's a negative thing to say. Probably none of your equity colleagues would really want to focus on that first out of the gate, but that goes to show as well a little bit of the style from fixed income, and particularly from a high yield trading background where the asymmetry of risk is stacked against you.
Yeah.
The best way to preserve capital and generate returns for investors over the very long run is to avoid the stuff that gets nasty as soon as you possibly can. So we want to be as open-minded as we possibly can, and that's how I guess I would describe my own style.
Always looking for problems.
Yeah.
I think that a lot of investors, that brings some comfort. Let's talk about the investment universe within Fidelity Alternative Bond Fund. So the strategy invests primarily, I would say, in two areas or parts of the fixed income market, if you will. For a large chunk of the portfolio, you're focusing on shorter maturity, investment grade bonds. There's also, a lever to pull with respect to, high yield or non-investment grade securities and allocation. So maybe I'll ask each of you to cover off one of those pieces and talk a little bit about, where it is you're investing, but as well as what the potential role is of that piece within the portfolio. So Olivier, why don't I start with you? Tell us a little bit about, the shorter maturity piece of the portfolio, and as I mentioned, where it kind of fits.
Sure, yeah. So the short-term investment grade piece of the portfolio, that's kind of the stable core of the portfolio. Obviously, the sort of conception of this fund is to have something that's less sensitive to rates, where you can generate an attractive return without taking on too much credit risk or too much duration risk. And that's where this part of the portfolio really comes into play. On the investment grade side, these are companies with solid fundamentals. We saw with Q1 earnings that momentum is continuing. Primary markets are wide open, so these companies have no problem accessing markets to refinance debt or fund CapEx, and defaults are very, very low. So you're not taking on a huge amount of credit risk in this part of the portfolio. And of course, on the short duration side, by definition, less sensitive to rates. What I would say too is, despite credit spreads in this space being on the tighter side, there's a decent amount of dispersion as well, which helps throw up opportunities both on the long and short side.
Let's talk about that in just a moment as well. So hold that thought. But Peter, why don't you talk a little bit about the high yield allocation? How is it complementary to what Olivier just mentioned?
Yeah, high yield as an asset class is a really interesting one. It's got a very solid long run return profile, high single digits, a very relatively low risk profile when you compare it to other asset classes like equities, where say the volatility of the S&P 500 over time is somewhere around 20. The volatility of high yield over time is also high single digits. So it's a great sharp ratio asset class. And within that, there's quite a broad range of diverse industries, household companies, startup companies, small balance sheets, big balance sheets. The nicest thing about it is the income stream, clearly, and the low duration profile. So using a strategic allocation to high yield in a flexible manner can really enhance income, enhance the investor outcome in terms of the overall return experience, and dampen down that sensitivity to interest rates.
Portfolio manager Max Lemieux joined Connects mid-month in both English and French to talk about Canada's resilient economy and Fidelity True North Fund. Max highlighted how Canada's energy, infrastructure, and resource sectors are thriving, even as global volatility and geopolitical tensions persist. In True North Fund, he stresses the importance of patience, diversification, and sticking with quality companies, while remaining cautious about overexposure to any one sector, preferring a balanced approach. As the world changes fast, Max's message is clear: to keep turning over rocks, staying diversified, and focusing on long-term value.
True North Fund is absolutely what it says it is. You're invested in Canada. Lots of people have tried to do it themselves for many, many years. Do you want to just tell us a little bit about what you think is sort of the Canadian story at this point that you are investing into? What's your broad view at this point of Canada?
Well, listen, a bit of same old versus the previous interview we did together. Like, I think the reality is we maintain a constructive view based on the long term. Remember that the current backdrop is very much similar, right? It's the globalization that is a little bit on hold, or getting a little bit more touchy on the edges. It's a different phase. Hoarding resources, right? The geopolitics make these countries, at least the Western world and other parts of the world, where you want to secure assets, resources for yourself because you want to manufacture more on your own soil, right? And Canada fits into the Western world alliance or bloc, if you want. And of course, we are aware of the current dialogues between the US and Europe and Canada. And it's a shifting ground where Canada still has a strong place in it because, as we said in 2022, when Russia invaded Ukraine, we mentioned back then, Canada is the mirror image of Russia. If something goes really bad in this world, we've got all the resources to supply the Western world with. And that's what we're seeing. I mean, think about Canada producing almost 4 million barrels a day of oil. We're starting to have LNG, right? We have the first terminal. It's been up and running for a bit less than a year. We'll have 2 more over the next few years. I mean, it's not like drastic, game-changing projects on a year-over-year basis, but there's a trend, an upward trend. I mean, rare earth, we're doing more. Copper, and we've seen more activity. There's like smaller, mid-sized companies that have been taken out recently. You can think of Foran that was purchased by Eldorado not too long ago.
There's a lot of M&A. We're really starting to see that. Are we at the beginning of a cycle on that? Or, I mean, it feels like there's a lot of announcements at the moment.
Pamela, it all depends on the commodity prices. If they can hold where they're are today. I mean, listen, copper just reached a new high. I don't know if it's going to stay there for the next while. I mean, remember, the money flows so quickly out there. It goes from one sector or from one commodity to another. There's not always a tangible rationale for it, except that the money flows and it moves. So it's something to be aware of, but based on current prices, there's nothing that will be stopping further M&A from happening. But remember, the mantra for True North and what we do at Fidelity, it's not necessarily based on a takeout. I mean, we like to own good quality companies or companies that have like amazing deposits when we're talking about resources, and that can be exploited at a very good cost, and therefore long life reserves usually means that there's tangible value, and that's what we've always done. So onshoring is happening, and we've got companies in Canada that touch on automation, robotics, they're benefiting from it. Some of them are still private, but I think we have good visibility that at some point we'll be benefiting from that trend as well. For sure, what happened so far this year is a bit different in terms of like these trends that we've mentioned. You have to layer on top the war in the Middle East, for sure. It disrupts the thesis on energy, but at the same time, the longer that we want it or not, the longer that conflict will last, the better off Canada can be at some point in terms of being strategically positioned, in terms of a supplier of choice with no political risk. So if Europeans want to supply their gas, get their gas from other places than Qatar or the Middle East, Canada is a good place to be.
So as I mentioned off the top, global markets are currently being shaped by 2 opposing major forces. On one hand, we're seeing a strong surge in earnings driven by investment in artificial intelligence. On the other hand, geopolitical tensions and inflation risks remain present, even as markets seem less reactive to them for now. Our final clip today features Fidelity's Director of Global Macro, Jurrien Timmer, who offers insight into this balancing act. He notes that markets are navigating robust earnings momentum while keeping a close eye on risks related to energy supply, inflation, and changing asset relationships. It's a dynamic environment. Here's Jurrien with more.
We're just about at the end of the earnings. There's some important ones still to come through. We've taken a look at sort of the consumer story and even the large tech players that when they have sensational earnings and the market still doesn't really reward them, actually punishes them a little bit, we can still see things overall tracking higher. It's still okay. Yep. And so
Yes.
I guess there's a reward for the earnings sort of in that way.
Yeah, and what often happens is when a sector or a theme is overly loved, like the AI theme, of course, is, and a lot of people are in those stocks, you need to keep besting expectations on and on and on to keep that momentum going, and that's a really tall order. Like that, there's going to come a point where NVIDIA or some other company is not going to be able to beat estimates, or no matter what they say, people want more, right? And so that's inevitable. Doesn't mean the stock is broken at all, or the theme is broken, but that generally happens when a trade gets crowded, and you have to argue that the AI boom probably is a little crowded here because it's very well known.
So with that, and taking into consideration what the bond market was doing last week, which did calm down sort of partway through the week, so arguably it's maybe that's not as sustainable. But you go in your report to take a look at what could be the hiccup and what it's essentially worth on the price side of things, should the bond market essentially become competition, because rates are so high and it's a pretty good return for a lot of investors.
No, exactly. So let's go to slide 6. Slide 6, and this is an important thing to kind of remember, is that again, earnings valuation is what drives the bus most of the time. And in this chart, I show the S&P 500 with a PE band. So the pink line is 20 times earnings, expected earnings. The yellow line is 22. And the orange line is 24 times earnings. And you can see that generally speaking, at least since 2020 or so, the S&P has traveled in that band. So that's kind of the band that represents earnings expectations at just about more or less reasonable valuations. Now sometimes you'll go above it, and then that might be a yellow flag that maybe investors are getting a little bit too ambitious. And sometimes the price level will just kind of fall below that band. And generally speaking, that's when either there's a massive shock, for instance, COVID in 2020, you see that there towards the left. But 2022, which was entirely a rate reset, we remember it well, of course, the PE just fell out of bed, even though the earnings were still pretty good. And so that's a way of showing that interest rates can kind of lurk sometimes in the background and maybe even come into the foreground.
So, thank you all for tuning in today. Each of those clips was from a 30-minute video podcast. All full episodes are available on YouTube, Spotify, Apple Podcasts, and more. We are putting out fresh content daily, so for more from us, please look up FidelityConnects or the Upside Podcast. The Upside, as you know, starts as a streamed webcast and is our public first show with the goal of simplifying investing content for all of you. So to not miss a live Upside, head to fidelity.ca and sign up for the next webcast or the Upside newsletter. Thanks for watching today, and I hope you'll join us again. I'm Kyle Cheropita. Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.